Thank you for joining the ULI Asia Pacific Thought Leadership Series. This month, our theme is Investment Trends and Capital Flows. As we head into the end of 2016, how has geopolitical and economic headwinds weighed on business activity? And what are we likely to see for the remainder of 2016 and into 2017? Presenting today will be Dr. Megan Walters, International Director, Head of Research, Asia Pacific Capital Markets for JLL. Over to you, Megan.
Thank you, and thank you to ULI for hosting me here today. My name is Megan Walters. I'm at JLL looking after capital markets research, and as some of you may have seen, soon to be looking after research slightly more widely for JLL. Today, we're looking at current investment themes. I'm just clicking the slides. Stephanie, if you could give me control of the slides. Oh, sorry, I've just received control of the slides. Thank you. So look, our key themes in Asia Pacific for the moment is the real estate markets weathered political and economic storms. That was the title from our global market perspective at the beginning of this quarter. For Asia Pacific, we see demand side for space to be solid on widespread Asian activity. It's easy to get sucked into the headlines about political and economic turmoil in the markets, and it's good to remember that fundamentally we have the weight of people and weight of capital here in this part of the world. Rents are growing in most of our markets. Occupier fundamentals from Asian domestics are the key driving force to that. In terms of future economic development going forward, we have the One Belt, One Road policy, which is moving China's outlook, and we're starting to see investment funds talk about One Belt, One Road as being a strategy for them to enter into what is one of our biggest markets in the region. Politically, look for the Trans-Pacific Partnership agreements that may or may not come into place. We're seeing some movement around the US in some of that, so that's definitely something to watch going out to the rest of the year. In terms of capital markets, we have a weight of Asian and global capital continuing to come into the region. We've seen a rise in intra-regional flows, so that's money flowing around inside Asia Pacific, and slightly a little bit less money flowing between the regions. We think particularly around Brexit and the volume of Asian money that would have gone to the UK, perhaps slowing down towards the end of last quarter. By country, we have a shortage of stock here in Asia Pacific. We've got so much money looking for stock. We're actually starting to see a lot more off-market deals being sought for core office. We've got strong demand for retail and industrial based on logistics. And I think if you had to sort of look at some of the themes going forward for the end of the year, it would definitely be investors going up the risk curve, looking for the best assets in newer or perhaps smaller cities. Here in Asia Pacific, physical and technical obsolescence of stock is always a challenge, particularly around strata title, and I'll say a few words about that. And then people very much looking at some of the newer sectors that they can go to. So if you have to go for your lunch now, that really is the key themes across the region. But let's take a deeper dive into some of the fundamentals. Sorry, I'm having trouble moving the slides forward. So Stephanie, could you move to the next slide, please? Thank you. So Asia remains the engine of global growth. So really the key point I want to make in this chart is the extent to which we're now seeing India as rising and becoming a theme for investors across the region. We know China's growth story. We've got it in the red bar on the line in the red there. China is slowing, but in many ways that's just simply it's a market maturity cycle. We've got growth coming in many markets, and India and ASEAN 5 are particularly two to look for. People still seeing a lot of strength in Australia. And there's some mixed outlook for Japan going forward. Stephanie, can you move forward, please? What it means is that India is gaining on Japan in terms of locations about where people want to go. What this chart shows is nominal GDP output, so how much stuff do the countries produce each year? And we've lined it up against the US and the EU area. So US in the grey, US in the black, EU in the grey, China in the red. Now what you can start to see is Japan in the darker blue squeezed between China in the red and India in the lighter blue on top. So you can see that Japan was very much a strong market, and then moving forward, the extent to which China just outpaces in terms of growth the rest of the region. And now you're just starting to see out to 2022, India accelerate and start to outpace Japan. So we're starting to see some shift in terms of investment flows about where people are going. Now, Delhi has some of the highest employment growth rate. So you'll see there we're showing it on a city-by-city basis at about 4% cumulatively from 2016 through to 2020. And when we get to real estate investment, it's very much on a city-by-city basis about where do people expect to see demand. India at the moment, we've got the population working in the services sector is about 27% in India versus about 50% in China. So still plenty of growth in terms of office markets for India. The domestic activity is particularly coming from the technology and media centers in places like Beijing. We've got Asian financial startups, in Shanghai, domestic startups, and in India, the business process outsourcing, and a lot of demand in Hong Kong at the moment for mainland Chinese companies. Now, what this means for the office markets is that we have rents growing in most of the markets, and that's based on widespread demand from local occupiers and to an extent some Western multinational occupiers that want to be in Asia. But really the story is it's one around domestic demand. We do have some areas where rents are falling, particularly oil and gas related areas, Jakarta and KL, and Singapore on a number of factors, very much on supply coming into the market. There's still plenty of demand for investors to place their money into Singapore, and we recently, along with CBRE, did a great deal for Asia Square. Looking through the rent clock, the way the rent clock works is you get some of the fastest growth around the 8, 9 and 10 o'clock rent positions. So some of the growth that we've seen across the region, Sydney up 17% year on year, Hong Kong up 11% year on year, Shanghai up close to 8% year on year. We've put London and New York on the chart just so you can see how they sit relative to everything else. If you want a really great breakdown of all the rents and the rent rises across the region and globally, do look at Global Market Perspective. Page 17 has a really great breakdown of all the sort of major markets around the region in our free-to-air publication. On a global comparison, we spend some time lining up the office rents. Now, what this chart shows is trying to put all the rents on a like-for-like basis. We all know, working in the region, that rents are measured in different ways, and whether it's on a net lettable area, gross floor area, or cost per square foot. What we've done here is try to line everything up so it's on an apples for apples comparison and converted it all into US dollars per square foot per year, which is why it will be quite difficult to pick out some of the numbers. But what we've done here is we've shown the Asian countries in the dark blue, and then the other, Asian cities in the dark blue, and then the other countries in the red colours. And you've got the net rent in the dark blue, and then the kind of service charge and additional costs in the pale colour next to it. So you can instantly see the extent to which Hong Kong outpaces the rest of the region. Obviously, there's a bit of currency effect in here because we've converted it to US dollars, but nonetheless, it really sets a picture of what the comparisons is in terms of cost to rent a square foot of office across the region. Hong Kong, very expensive. Next highest, Beijing, Shanghai, and Tokyo. But if you look down, what you find out is that Sydney looks incredibly cheap to rent a square foot of office space when compared to the rest of the region. So when we look forward to rent growth, when we show a chart, when we show a chart saying we expect rental growth from the end of 2015 to the end of 2018 to be up 30% in Sydney, the reason we can expect that level of rent growth is, to an extent, we've already seen 17% of rent growth of where we are now to where we were a year ago. And Sydney is, when compared to the other global city markets, relatively inexpensive. On this chart, we've also shown our other sort of core markets and perhaps some of the tier 2 markets, showing where we expect rental growth and capital value growth out to the end of 2018. Turning to retail, just for a few minutes, consumer spending obviously is a big part of the story for this part of the world. We've got rising wealth, populations moving into productive earning capacity, so that, you know, the demographic dividend coming through. So we've got places like Delhi, Beijing, and Shanghai, and we've noted here consumer spending outpacing population growth. So quite understandably, investors are particularly interested in retail around the region. There is some movement around online and outlets and overseas in terms of shifting patterns of spending. Nonetheless, people very interested. The one problem that we've got in this part of the world is strata shopping centres and indeed strata title property generally. We've had this slide around for a little while. You will have seen it come from our China deck. And really we put it in just to make the point that not all retail is equal. So if you have investment clients looking at retail, be extremely cautious about the type and style of retail that they're looking at. On the rent clock for retail, again, we have rising rents around the region, really on good demographics, perhaps Hong Kong falling away a little bit on mainland Chinese tourism, not going into Hong Kong quite as much. It's relatively expensive with the strength of the US dollar. Chinese tourist shoppers can find that they can shop more cheaply elsewhere, particularly at the moment the UK and Europe being some places if you want to go and buy a decent handbag. Food and beverage dining in malls now continuing to make up, sort of increasingly making up 30% of what's going on in malls, and we expect that as a trend to continue. So I think generally the sort of main picture is retail in great demand. There are some malls built in the wrong place. There are some malls that have been started off. They're not successful, so tread carefully around retail. Industrial, very much the same story, steady demand on a growth story of logistics, and really it's a supply and demand dynamic that you can see in some of the markets coming round. For investors, absolutely top pick because they want the yield that it delivers. In terms of the sort of total returns right across the region, we've tried to line everything up. Now, this chart doesn't say anything to risk. It's just giving you a total returns picture with the income component in the dark color and the gain or loss in the capital value in the lighter color sat on top of it. So you've got Mumbai and Bangalore obviously sitting at the top because their yields are some of the highest, and then you're going through to Shanghai, and we've color-coded it whether it's office, retail, and industrial running right through. If you have property in the right-hand side of the chart, perhaps showing capital values falling, I think the key message there is to hold through the cycle. If you do wish to exit, then we have a queue of investors that would be willing to take your property off you, and do speak to my colleagues in capital markets afterwards, and they'd be delighted to help. That leads us on to the big question around yield. Where are we going? Global monetary policy is likely to be looser than for perhaps longer than we expect. Probably the best report out in the market at the moment, other than our great JLL reports, is the Bank of England report. And I'm just going to highlight it to you because you'll see it written about in places like the FT and Reuters. Bank of England report, it runs to 66 pages, and it's called Secular Drivers of Global Real Interest Rates. And it makes the point that the natural real rate of interest has fallen by about 450 basis points. And for a number of reasons, including demographics, saving glut, public levels of investment, it's unlikely to come back. So notwithstanding the desire for central banks to raise interest rates because of the fall in the natural real rate of interest, policy rates are unlikely to be able to accelerate back to anything like some of the more normal positions that we've seen. So if anybody wants a copy of the report or can't find it, do send me an email afterwards and I'd be happy to send you a copy. Now, what that means is for office market yields have compressed since the global financial crisis, and here we've used a basket average of where we are from 2007 through to 2016. And what you can see is a natural, slow, steady compression of office yields. When you look to see what is the risk premium for owning property, you find that the risk premium for owning property actually sits at its long-term average. So although we have seen office yields compress, they have very much compressed in line with falls in, whether you call it monetary policy rates, it's always the real rate. Office yields have fallen in line with the natural real rate, and your risk premium for owning property sits at historic norms. What this chart shows specifically is we always use the real 10-year government bond rate. Property yields are real and need to be judged or measured against real bond rates or real 10-year government bond rates. So that's in the darker red color that falls below the line. Your natural unlevered prime office yield, your just straightforward initial yield that you might expect, is shown in the purple color. And on here we've put an estimated cash on cash yield for you. So some of the best estimated cash on cash yields that we've got will be around places like Tokyo, where the cost of debt is right down at 0.7%. Some of the other cash on cash yields that you see in our core markets, Sydney, again, cash on cash yield of about 6% in line with Tokyo. The premium that we're showing is the gap between the unlevered prime office yield and the 10-year government bond rate. So that is your natural risk premium for owning property. I just popped on the chart just to make the point we know and understand about currencies. If you look online, you'll see that over the number of years we've done a report showing property returns when measured in other currencies, so you can see which investors might be most interested in which locations. Our next version of that report is due out in the next 2 to 3 weeks. Notable yields around the region, notable deals and transaction yields around the region. These are average transaction yields. Core, shiny, prime property is selling at sharper yields than these. These are very much sort of where you might be on a market average. If you've got something super shiny, it will sell for more compressed yield. The investment markets, as I said, we've got a weight of capital in the market. The investment market volumes measured, I appreciate many companies measure them in slightly different ways. In the way that we measure them, we see them as being down just sort of -4% at the half year where compared to the same time a year ago. Much of that shortfall was actually in Japan in the first quarter when the government implemented negative interest rates in February. A number of large deals no longer went through transactions and were refinanced. If you're looking for kind of this measure as being a health of the market, the overall picture, I would say that the market is healthy. We have a shortage of stock, not a shortage of capital. Just looking at capital around the region, we are still net exporters of capital, notwithstanding we have money in, particularly coming in from the Qatari money coming into Singapore, certainly bumped up the numbers. But mostly we are still net exporters of capital. We still have domestic buyers buying in their home location, about $40 billion in the region out of the $54 billion that we had in the first half. And AP cross-border investors is very much something that we're increasingly seeing a rise in that. And that will be China going into Hong Kong, China looking at Japan, China looking at Australia, and then obviously elsewhere in the region, South Korea and the Singapore money traveling around the region. Just to run through a kind of, in the last few slides, just some of the key points to highlight in some of our major markets. Australia, one of the things we started to see was if you wanted to invest in a market that maintained its AAA rating and had an English-style rule of law and didn't want to go to London, then we felt that perhaps Australia might continue to attract international capital. There's strong demand based on rising rents. Investors looking for yield are moving into some of what we might call the secondary markets. In particular, Brisbane is looking attractive. We've got a lot of investor interest there. So I think kind of the key phrase there is lots of capital with limited assets on the market. Japan, big market of choice for everybody. Some of the landlords aren't motivated to sell because they have been refinancing assets. Investors are moving into regional cities. One area where there's been good success in the market is looking at the multifamily residential sector. We've just done a report on multifamily residential. My colleague Nick Wilson has got that out in the market if anybody would like to see a copy of that. Obviously hotels, lots of interest there from tourism. Skiing is great in Japan, and obviously the Olympics moving forward. And really the rise of Chinese tourism moving up the value curve in tourism, and particularly looking at things like ski resorts. Over in Shanghai, a real core city with good liquidity for international investors. If you look at the Shanghai market, proportion of foreign buyers in the market, you find it to be high and really on a par with our other international cities such as Sydney. Office fundamentals remain strong demand, relatively controlled supply with rising rents. And so plenty of activity to go into the market. If anything, actually, one of the problems is, again, insufficient stock for the volume of capital looking to get into the market. Just to finish off, Singapore, plenty of foreign investment looking to come into Singapore. Obviously, we have a supply and a demand, one might say a mismatch at the moment. Our brokers and research team at the moment we do have office rents falling. I don't think that's a surprise to anybody from where it is on the rent clock, and we are expecting a bottoming out in 2017. So in terms of a time to get into the market, now might be the time. And finally, to finish off on Hong Kong, in time for your holiday up there, lots of demand from Chinese end users. I think the big story is mainland Chinese insurance companies looking to buy assets to occupy, and lots of other Chinese organizations looking to really embed themselves into the market. Some developers are electing to sell non-core assets to capitalize on some of the high pricing that we've got in the market there. So plenty of demand from particularly the Chinese investors to be in Hong Kong. So to finish off, little bit overrun on the time. If anybody needs the slides, do drop me a note. I'll leave my email address on the last slide. So look, if we had to summarize, we've got plenty of money in the system still. We've got investment returns that we expect to be stable, well, at least over the next 12 months. We've got a question around what happens with interest rates going forward. My view is they will be lower for longer, and I think that will continue to drive a weight of capital into real estate looking for productive assets. Rent growth is what people are looking for and what people are buying, and we have strong continuing interest both from domestic groups and international investors into Asia Pacific. So with that, I'll go to the last page, which has always got our contacts and disclaimer on, and hand you back to Stephanie. Thank you.
Thank you, Megan, for that wonderful presentation. Thank you for everyone's time. The recording of this presentation will be sent to all the ULI members. Of course, if you aren't currently a member, please feel free to contact us for more details. Have a great afternoon, everyone. Thank you very much.
Thank you.